So I stumbled across something really interesting this week, and honestly, it made me pause. Billionaires, the people who literally have armies of analysts and insider access, are dumping tech stocks right now. And I mean dumping them. We're not talking about a little profit-taking here and there. We're talking massive, coordinated selling that should make all of us sit up and pay attention. Let me break down what I found. Warren Buffett, probably the most famous investor on the planet, sold over $133 billion worth of stocks through the first 9 months of 2024. And by the end of the year, that number jumped to $143 billion. Think about that for a second. That's not just big, that's historic. He cut his Apple stake by nearly 70%, and this is a stock he's held for years and praised publicly. He also sold more than 600 million shares of Apple in 2024. He's been selling Bank of America too, quarter after quarter. Now, here's what's fascinating. Buffett isn't running away from the market entirely. He's been buying smaller companies, stocks like Domino's Pizza, VeriSign, and SiriusXM. He is simply saying that the megacap tech stocks are overvalued, but there's still opportunity if you know where to look. Berkshire's cash pile ballooned to $334 billion by the end of December 2024. That's not money sitting idle by accident, that's Buffett waiting for better prices. But it's not just Buffett. I found that other billionaires are making similar moves. Stanley Druckenmiller, Israel Englander, and Jeff Yass have all been selling shares of Nvidia and Palantir Technologies. Ray Dalio reduced his Palantir position by 19%, while Philippe Laffont closed his position entirely. These are the people who rode the AI boom to massive profits, and now they are cashing out. And then there's the CEOs themselves. Mark Zuckerberg sold $307 million worth of Meta shares between early February and late February 2025. Jamie Dimon sold over 866,000 shares of JP Morgan valued at about $234 million. Now, I know these sales were pre-arranged, they have to be for regulatory reasons, but the timing is worth noting. These sales happened right before the market started getting rocky. So what's driving all this selling? Well, I dug into it, and there are several things happening at once. First, there's the valuation problem. Tech stocks, especially AI-related ones, have gotten expensive. Companies like Palantir are trading at astronomical price-to-earnings ratios, some analysts cite multiples as high as 700 times earnings. To put that in perspective, stable industries typically trade at 15 to 20 times earnings. Nvidia reached a historic $5 trillion valuation in November 2025. The question everyone's asking, are these valuations sustainable? Then there's the AI bubble concern. And this is where things get really interesting. The Bank of England and the International Monetary Fund have both warned about growing risks of a global market correction due to possible overvaluation of leading AI tech firms. NYU finance professor Aswath Damodaran said the market isn't pricing in something potentially catastrophic, and he's considering moving his money into cash and even collectibles like baseball cards. When a finance professor who's typically bullish starts talking about baseball cards, you know something's up. Scott Galloway, the NYU marketing professor, warned that the US faces either chaos in the labor markets or a severe market correction that could see the Magnificent Seven technology stocks cut in half within the next 12 months. Now here's what really caught my attention. There's circular financing happening in the AI industry that's reminiscent of the dot-com bubble. What does that mean? Well, Nvidia gives money to companies like OpenAI so they can buy more Nvidia chips. OpenAI makes deals worth billions with companies that then invest back in OpenAI. OpenAI is committed to investing $300 billion with Oracle over 5 years, but OpenAI's projected revenues are only expected to reach $13 billion in 2025. The math doesn't quite add up, does it? And get this, in August 2025, an MIT report stated that despite $30 to $40 billion in enterprise investment into generative AI, 95% of organizations are getting zero return. That's a sobering statistic. But wait, there's more. We had an actual stock market crash earlier this year. On April 2, 2025, which President Trump called Liberation Day, he announced sweeping tariffs that triggered widespread panic selling across global stock markets. The Nasdaq suffered its steepest drop since 2022, with the 7 most valuable tech companies losing more than $750 billion in market value in a single day. The Nasdaq fell from 20,204 to 17,398 over 32 trading sessions, a 14% decline. Now, the market has recovered since then. By June 27, 2025, the S&P 500 and Nasdaq closed at all-time highs. But the volatility spooked a lot of people, billionaires included. There's also recession fear in the air. Oxford Economics warned that America's heavy reliance on tech investment leaves its economy vulnerable, and that US GDP would have barely grown in the first half of 2025 without tech. They modeled a scenario where a US-centered tech downturn would see domestic GDP growth fall to 0.8% in 2026, which they described as flirting with recession. Jamie Dimon said in October that while AI is real, he believes some money invested now will be wasted, and there's a higher chance of a meaningful drop in stocks over the following 2 years than the market was reflecting. But here's the thing, and this is important, not everyone thinks we're in a bubble. Unlike the dot-com era, today's AI leaders saw their earnings expected to grow by 17% over the next year, whereas in 2001, tech leaders' annual net income dropped by 65%. Howard Marks, the famous investor, said that while there's excitement for AI, he hasn't seen it reach a critical mass of mania that indicates a definite bubble. And demand for AI is real. According to some analysts, AI-related stocks have contributed to roughly 75% of the S&P 500's returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November 2022. So what should you make of all this? I think the billionaires are sending us a clear message: be selective. They're not abandoning tech entirely, they're just being more careful about valuations. A rotation out of some of this year's top-performing AI players isn't necessarily a bad sign for those stocks over time or the market in general. Here is my take: the AI revolution is real, but we might be in the hype phase where prices have run ahead of fundamentals. The billionaires who've made fortunes timing the market are taking some chips off the table. That doesn't mean you should panic and sell everything, but it does mean you should be asking tough questions about valuation. Buffett believes there are still a lot of stocks in the market that present good value for investors, but he simply can't invest enough capital in smaller companies to offset the massive amount of cash he raised by selling large-cap stocks. For us regular investors, that's actually good news. We can still find opportunities in places Buffett's too big to play in. The bottom line? Pay attention to what the smart money is doing, but don't just blindly follow. Do your own research, understand what you own, and don't chase stocks just because they've been going up. The market rewards patience and discipline, not FOMO. That's what I'm seeing right now. What do you think? Are we in an AI bubble, or is this just a healthy correction? Drop your thoughts in the comments below.